New York City, September the 22nd, 1985. You're James Baker, newly appointed Treasury Secretary. The dollar has appreciated 50% in 5 years. American manufacturers, Caterpillar, IBM, Motorola, are screaming for protection. Congress is drafting protectionist legislation that economists say will destroy the global trading system. You convene the G5 at the Plaza Hotel. France, West Germany, Japan, the UK and the US. Target: depreciate the dollar by 10 to 12% through coordinated intervention. The market responds immediately. By September 24th, the yen has appreciated 10%, from 240 yen per dollar to 214.9. But the yen doesn't stop at 12%. It doesn't stop at 20%. By early 1988, the yen stands at 125 per dollar, 73% appreciation, 6 times the target. What happens next takes 35 years to fully resolve. This is the independent financial historian. I perform autopsies on dead empires. The Plaza Accord successfully reduced US trade deficits and forestalled protectionist legislation. But what it triggered in Japan became a case study in how currency intervention creates conditions for financial catastrophe through institutional vulnerabilities and prolonged monetary accommodation. Let me walk you through the forensics. To understand the urgency driving Plaza, you need to grasp Japan's extraordinary dominance by the early 1980s. Japanese automobile firms produced 49 cars per worker year. American manufacturers struggled to match half that productivity. Toyota and Nissan delivered vehicles with superior reliability, fuel efficiency, and design innovation that made Detroit's offerings look like rust-prone dinosaurs. The pattern extended across consumer electronics, semiconductors, steel, industrial machinery. Japan's current account surplus exploded from an $11 billion deficit in 1980 to a $35 billion surplus by 1984, a $46 billion turnaround in 4 years. Harvard sociologist Ezra Vogel published Japan as Number One in 1979. It became a bestseller. By the early 80s, serious economists discussed whether Japan might overtake the United States as the world's largest economy. MIT economist Lester Thurow declared in 1989, "The 21st century belongs to Japan." This wasn't speculation. This was consensus among policy elites who had watched Japan's export machine crush American manufacturing for a decade. But Japan's dominance was amplified massively by exchange rate dynamics that American manufacturers viewed as fundamentally unfair. From 1980 to 1985, the US dollar appreciated approximately 50% against the yen, Deutsche Mark, French franc, and British pound. This made American exports more expensive for foreign buyers while making imports into the US cheaper. The mechanism? Paul Volcker's tight monetary policy, federal funds rates exceeding 20% in 1980 and 1981 to crush inflation. Simultaneously, Reagan's expansionary fiscal policies, tax cuts in 1981, increased defense spending, enlarged budget deficits, and attracted international capital seeking dollar assets. By March 1985, the dollar stood at 260 yen, substantially stronger than 250 yen in 1982. The US current account deficit reached 3.5% of GDP. The merchandise trade deficit exceeded $120 billion annually. American manufacturers mobilized politically. Caterpillar, IBM, Motorola, grain exporters, automotive firms, they demanded intervention. By 1985, Congress began seriously considering protectionist legislation that economists recognized would damage consumers and destabilize the global trading system. When James Baker replaced Donald Regan as Treasury Secretary in January 1985, the calculus shifted. Baker and his team viewed intervention as a legitimate tool to forestall protectionism. The G5 deputies developed confidential targets before the ministerial meeting. The non-paper draft specified 10 to 12% dollar depreciation. Intervention shares, 25% each for the US, Japan and Germany, 12.5% each for the UK and France. Total intervention, approximately $18 billion over 6 weeks. The public communiqué, announced Sunday, September 22, 1985, carefully avoided specific language about intervention or targets. It stated that some further orderly appreciation of the non-dollar currencies is desirable, and the 5 nations stand ready to cooperate more closely. This circumspect language masked aggressive coordinated action. When interventions commenced, the dollar fell 4% immediately. During the crucial 6 weeks following Plaza, actual interventions proved substantial. The US sold $3.2 billion, Japan sold $3 billion, Germany, France, and the UK combined sold approximately $2 billion. The yen appreciated from 240 per dollar to 214.9 within days, 10% in less than a week. But here's the revelation that changes everything. Bank of Japan. Governor Sumita publicly forecast in October 1985 that the yen would continue appreciating. The central bank governor was signaling that authorities expected and accepted further appreciation. The market responded. By the end of 1985, the yen reached 200 per dollar. By early 1988, 125 yen per dollar. 73% total appreciation from March 1985 levels. Not 10%, not 12%, 73%. This massive yen appreciation created what Japanese economists termed endeka fukyo, recession induced by expensive yen. The mechanism was brutal. A Japanese automobile costing 1 million yen, previously purchasable for $4,200 at 240 yen per dollar, now cost $8,000 at 120 yen per dollar, same yen price, double the foreign currency cost. Unless Japanese exporters slashed yen prices, accepting margin compression, export volumes would collapse. GDP growth fell from 5.2% in 1985 to 3.3% in 1986. The Ministry of Finance and the Ministry of International Trade and Industry feared sustained high yen would fundamentally deindustrialize Japan, shifting production overseas and destroying competitive advantages built over decades. The policy response: massive domestic stimulus, both monetary and fiscal. The Bank of Japan began cutting rates aggressively. The official discount rate stood at 5% when the Plaza Accord was signed. January 30th, 1986 cut to 4.5%, March 10th, 4%, April 21st, 3.5%, November 1st, 3%, February 23rd, 1987, 2.5%, a full 2.5 percentage points in less than a year. The lowest official discount rate in post-war history. If you're realizing everything you thought you knew about central bank policy is wrong, hit that subscribe button. This is the Independent Financial Historian. I perform autopsies on dead empires so you see the patterns before they repeat in your backyard. Drop a helicopter emoji if you're positioning yourself for what's coming, and tell me what you want me to dig into next. I read every single one. Here's where the policy error becomes catastrophic. The rate of 2.5% represented aggressive easing designed to counter the endeka shock. Reasonable, if temporary. But the Bank of Japan held the official discount rate at 2.5% from February 1987 through May 1989, more than 2 years. By the end of 1986, the economy had begun recovering. Exports stabilized. GDP growth resumed. Yet monetary policy remained extraordinarily loose. Why? The Ministry of Finance pressured the BOJ to maintain stimulus. The Ministry of International Trade and Industry feared deindustrialization. Political pressure overrode economic signals, but prolonged easy money alone doesn't explain the bubble's magnitude. The transmission mechanism, how liquidity flowed into speculation, involved a uniquely Japanese institutional vulnerability: window guidance. Window guidance originated as a wartime credit allocation mechanism. The Bank of Japan would communicate quarterly lending targets to individual commercial banks. During the bubble years, banks were instructed to increase lending by 15% annually. When profitable corporate borrowers declined additional loans, they were flush with cash from export success. Banks faced a dilemma. Meeting lending quotas required finding borrowers. Maintaining soundness required ensuring repayment. The resolution proved catastrophic. With productive corporations unwilling to borrow, banks turned to real estate speculation and less creditworthy borrowers. Japanese banks dramatically expanded real estate lending, financing land purchases and property development at increasingly inflated prices. As land prices began rising, appreciation itself attracted speculation. Investors purchased land expecting continued price increases, borrowing from banks to finance purchases, intending to sell at a profit. Banks accepted land as collateral at inflated valuations. Self-reinforcing cycle. Land prices rose, collateral values increased. Additional borrowing, additional purchases, prices rose further. By 1989, Tokyo real estate sold for $139,000 per square foot, 350 times Manhattan prices. The grounds of the Tokyo Imperial Palace, 1.15 square kilometers, were estimated to be worth more than the entire real estate value of California. Land in the Ginza district peaked at 30 million yen per square meter, approximately $218,000 per square meter. By 1986, Tokyo commercial land prices had surged from 2.2 million yen per square meter to 4.2 million yen per square meter, a 122% increase in 1 year. The stock market paralleled this madness. The Nikkei 225 gained roughly 75% from 1985 through 1986 and continued climbing. On December 29, 1989, the Nikkei closed at 38,915.87. At this peak, Japan accounted for 42% of global stock market capitalization. 8 Japanese companies ranked among the world's top 10 by market cap. The only American company in the top 10, ExxonMobil, in 6th place. The price-to-earnings ratio on the Nikkei reached 60 to 70 times trailing earnings. For comparison, the US dot-com bubble peaked around 30 to 40 times earnings. Japan's valuation was double the dot-com extremes. By early 1989, even within the Bank of Japan, concerns were mounting that monetary policy had remained too loose far too long. When Yasushi Mieno assumed the governorship in December 1989, he adopted an aggressive tightening stance. Mieno viewed his role as the watchdog of prices, fearing continued ease would generate inflation and destroy BOJ credibility. Mieno raised the official discount rate from 2.5% in May 1989 to 6% by August 1990. An extraordinary reversal. More consequentially, Mieno deployed window guidance in reverse, imposing total volume restrictions on real estate lending. Banks were ordered to stop lending to the property sector immediately. The impact on asset prices was devastating. The stock market began declining in January 1990 and had fallen 50% by September 1990. The Nikkei dropped from 37,189 on January 4, 1990 to 23,849 by December 28, 1990, a 35% decline in 1 year. The decline continued. By August 1992, the Nikkei reached 14,000, a 75% collapse from the 1989 peak. Land prices declined for 15 consecutive years beginning in late 1990. Commercial land prices that had risen 302.9% compared to 1985 levels collapsed as momentum reversed. The banking crisis proved catastrophic. Banks had lent enormous sums based on collateral valuations driven by speculation. As property and stock prices collapsed, collateral evaporated. Loans to well-capitalized borrowers secured by appreciated assets suddenly became loans to insolvent counterparties, with collateral worth far less than outstanding amounts. Non-performing loans exploded. The cumulative amount disposed of by Japanese banks from 1992 through 2001 reached approximately 90 trillion yen, equivalent to roughly 80% of loan growth during the bubble years. The period following the bubble burst proved far more destructive than typical recessions. Economist Richard Koo's analysis, termed a balance sheet recession, explains why conventional policies failed. In normal recessions, declining demand causes firms to postpone investment, but firms retain profitable opportunities if credit and rates are favourable. In a balance sheet recession, asset price collapse renders firms insolvent on an economic basis. Their liabilities exceed asset values. Facing insolvency, firms' objective shifts from profit maximization to debt minimization. Despite zero interest rates and massive monetary expansion, Japanese corporations in aggregate opted to pay down debt rather than borrow to invest. From 1995 through 2005, a full decade, corporate Japan was a net repayer of debt. In some years, net debt repayment reached 30 trillion yen, equivalent to 6% of GDP. Corporate investment fell from 22% of GDP in 1990 to substantially lower levels throughout the 90s and early 2000s. The economy couldn't grow because the private sector was deleveraging rather than investing. Deflation compounded the problem. As aggregate demand remained depressed, firms reduced prices. Consumers delayed purchases expecting lower prices, reducing demand further. The nominal GDP in 2001 was approximately the same as 1995, zero growth over 6 years. From 1991 to 2003, the Japanese economy expanded at only 1.14% annually, well below the 3 to 4% growth typical of developed economies. The average real growth rate from 2000 to 2010, approximately 1%. Japan's government debt exploded from 13% of GDP in 1990 to 134% by 2003, the highest ratio among developed economies. By 2011, Japan's nominal GDP had declined by more than $1 trillion from 1995 levels. Only with Abenomics, implemented beginning in 2013 under Prime Minister Shinzo Abe, did Japan's policy regime shift fundamentally. The Bank of Japan announced commitment to a 2% inflation target and launched massive quantitative easing, 60 to 70 trillion yen of bond purchases annually. The effects took time, but Abenomics ultimately proved successful in breaking deflation. In February 2024, the Nikkei finally reclaimed and exceeded its 1989 peak. 35 years to recover. 35 years. Let that sink in. The Plaza Accord achieved its immediate objective, reducing US trade deficits and forestalling protectionism. But the mechanism through which it operated, massive yen appreciation triggering prolonged monetary accommodation, created conditions for financial catastrophe. Germany faced comparable Deutsche Mark appreciation. Germany tightened by 1988. Japan held rates at 2.5% for 2 more years. The difference? 3 decades of stagnation. The autopsy is complete. The cause of death? Prolonged monetary accommodation meeting institutional vulnerabilities that forced credit expansion into speculation. The duration of easy money, not the initial response, proved catastrophic. It took 35 years to reclaim the Nikkei peak. 35 years. The question isn't if policy errors have consequences, it's whether you'll recognize the pattern before it